Basically, everyone has a gross taxable income, and you can reduce your gross taxable income, and that's what your income taxes are calculated on. And one way you can reduce it is by having expenses. The IRS recognizes that properties being owned are being quote unquote used up during their life. And the life of a residential property is 27 and a half years.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to Watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, hey, you're looking to save some money on taxes, especially if you're in real estate, then the person you are about to hear from is somebody you want to pay close attention to. His name's Joseph Viery, and the company that he runs is called U.S. Tax Advisors Group. Joseph, great to be here with you. Thanks for coming on.
Hey, Kerry, thanks for inviting me.
So, tell us how this works. Cost segregation studies, what are they? Why do you need them? And what good are they?
Perfect. Well, let me start by saying that we're an engineering-based firm, and I'm not an accountant, so I'm not giving anybody accounting advice. I'm not an attorney. I'm not giving anybody legal advice. So I've been in the business since 2007, and I'm going to give you a high view of what cost seg is. Basically, everyone has a gross taxable income, and you can reduce your gross taxable income, and that's what your income taxes are calculated on. And one way you can reduce it is by having expenses. The IRS recognizes that properties being owned are being quote unquote used up during their life. And the life of a residential property is 27 and a half years. For a commercial property is 39 years. These 2 years are made up by Congress. I have no idea why they picked those years. Somebody could Google that and get a better answer than me. But bottom line is they're saying you're using up your property. So if you divide the building basis by 27 and a half or 39 years, it doesn't take, an incredibly economically sound person to know that you're getting a little bit of an expense every year. However, the correct way to depreciate a building, according to the IRS, is by breaking out the shorter lived assets of the building. Okay, what do I mean? I'm talking about the interior of the building is 5 years, which would be things like countertops and cabinets and flooring and window coverings, and then 15-year life of the landscaping or the outside of the property, land improvements like irrigation, like driveways, swimming pools, fencing. And so if you have the 15-year and the 5-year property, we usually find about 30% of the building basis that can be put in these shorter lives. So let's do a little math. Let's say that you have $1 million building and we find $250,000 in the shorter life assets, 15-year and 5-year. You can take, well, if it was 2022, you could have taken 100% of the 250,000 and completely written that off against your taxes, which is huge. That means if you had a $500,000 taxable income, I just cut it in half, and now you've got a $250,000. So I've saved the property owner or owners a ton of money. And so that's basically what we do in cost seg. The IRS recognizes all of these short life categories and components, and as an engineering company, we identify them, we put the correct cost to them, and basically we give the accountant or the taxpayer the report that shows what can be accelerated so that they can significantly reduce income taxes in the current tax year. I mentioned the 100% was last year. It's now reducing every year for the next 5 years. So in 23, it's not going to be 100%, it's going to be 80%. It's not a big deal. All it means is I'm going to be able to take that same example, the $250,000, and give the taxpayer 80% of that money. And then the 20% they're still going to get, but it's going to be over time. They're going to get the rest of that, all of that depreciation over the next following couple of years. So that's basically how cost seg works, and a little bit in how bonus depreciation works.
Okay, so so many real estate investors fail to take advantage of this, don't they?
Oh my gosh. I've been doing this since 2007. The first objection I got back in the dark days was, oh, this must be a scam. This can't be true. Well, now all I need to do is tell anybody to go to Google audit technique guidelines for cost segregation. It's compiled by the IRS. That's our Bible, our mantra. We follow the IRS and the audit technique guidelines. So that question's done. Everybody knows, accounting and taxpayers, that this is legitimate. Now it's just a matter of letting all the accountants and taxpayers know that this is the correct way to depreciate a building.
Okay. So this is an engineering study that takes place. Do you visit the property when you're doing this?
Back in the day when I first started, we only dealt with bigger buildings, like $1 million building basis. And what do I mean by building basis? Here's how you calculate it. Whatever you paid for the building, now this is not what it's worth, it's what you paid for the building, less the land is the building basis. That's the number I have to work with. So bottom line is we take the building basis and we work off of that number, and we calculate how much accelerated depreciation the taxpayer's entitled to.
Okay. Right. So now it's a lot different than it was. At what price of a property does this become worth doing? If I buy a house for $250,000 that I'm renting out to, it's an investment property, should I do a cost seg study?
Well, you know what, to further embellish on your last question. So what happens is that if we have a building basis in the old days of $1 million or more, we never used to deal with small buildings. We would do the detailed engineering study, which meant we would have to send somebody out to the property to document the property, take photos, measure everything. The engineers would take all that information and they would do their calculations. However, about, 7 or 8 years ago, we came up with an analytical approach where we basically do not need to go to the property and we can do everything in-house. Now, we only do this for smaller buildings that have a basis of $750,000 or less. So if we do the analytical study, the price is a lot lower. It's, we charge anywhere from $625 to $675 for an analytical study. So we can now study buildings as low as a single family home that has a building basis of $75,000, and we can make it work. If you have a building basis over $750,000, then it's going to be more expensive, but then the return on your investment, the return on the fee is going to be a lot higher because your building basis is a lot higher. We're going to save somebody with $1 million building $250,000. We're not going to charge you $625 or $675. We're going to charge you probably $4,000. Well, it depends. I'll give a range from $2,000 to $4,000 on that size of building. So it's still going to be worth it, but we will have to go out to that building, the bigger buildings, and do the on-site review.
Okay, and the IRS has no problem with you remotely doing these studies.
No, I'll be very clear. It's in the audit technique guidelines. However, it's not the number one methodology. The number one methodology is if we do the detailed engineering and we go out and we measure everything and we do it all correctly. What we're giving the IRS when we do the analytical study is we're using our database of thousands and thousands of properties. We're looking at the property individually. We still look at it. We still want to see the inside, but we can see the inside from photos. So we're doing a really good job. And the yields aren't as high as a detailed engineering, but for somebody with a smaller building, it's still going to make a very sound investment. You're still going to get an accelerated depreciation, and you're still going to get U.S. Tax Advisors Group to defend the report if questioned by the IRS.
Okay, I like it. I like the fact that you've made it a much easier process, and you don't have to go out there, because I know that prior you had to go out.
Yeah, we did every building. And so that's why, unless you owned a big building, it wouldn't make sense to do cost seg. But nowadays, it does make sense. So I have lots of clients now with single family homes, 1, 2, 50. And now they can afford to do it.
All right. Hey, really fascinating. If we want to contact you, perhaps retain your company to do a study, Joseph? How would you go about doing that?
Yeah, and what we do, how the process that works, Kerry, is that we provide a no-cost estimate and a proposal, of course, the fee. And basically, if you go to USTAGI.com, and you will find, I think the first what I would recommend is schedule a call with one of our staff members just to go over, the process and to make sure that, they're a good candidate.
Mm-hmm.
And then we will send you a link and you'll fill out your property information. I just need some basic questions. If it's a current tax year acquisition, like if you bought it in 23, now we're dealing with the 23 tax year. I just need to know, how much did you pay for it? Do you know the land allocation? And if not, I'll estimate the land allocation. How much of that we got to deduct from the acquisition cost? When you bought the property and the address of the property. From that information, that's all I need. If it's a look-back study, and by the way, I can go back 15 years to do a look-back study. If it's a look-back study, you already filed your tax return. So I need a piece of paper called the Federal Tax Depreciation Schedule, where you or your accountant has already answered the questions I need, which is, how much is the building basis? When did you buy the building? And are there any capitalized improvements since you bought the building? So with that one piece of paper, really all I need is the address of the property and the depreciation schedule. And if we need more information, we'll reach out. But basically, that's it. And then I follow up with an estimate and the fee. And then you take it back to your accountant or your team and decide whether this is going to be something you want to do.
Right. And then obviously, if you missed it when you bought it, you can carry back, right?
Yeah, and you can still get 100% bonus if you fall in the 100% bonus years. So if you bought the property of 2017 to 2022 and you haven't done it, those are the 100% bonus years. I can go back and calculate the 100% bonus. But anything acquired in 23 now is 80%, and then 24 is 60, 40, 20, 0.
All right, but even when it goes to 0, then so you write it off over how long a period do you do it?
5 years. You'll get the bulk of it, 80% so don't forget this, Kerry. I started in 2007 where we had no bonus depreciation. So it was never a factor. So I know a lot of my competitors, they use bonus depreciation to scare their clients and say, oh, you have to do it this year. I'm not in that camp because I go back so far that we never had bonus and it was not a big deal. I still was crazy busy. What it means is instead of getting your 100% or 80 or 60, you're going to get a big chunk of it, like say about 80% the year you do the study. The other 20% you're going to get over the next 5 years. It's a mathematical equation and so I can't say it's 5 years exactly. It could be 4 years. It could be 6 years. It just depends on how much of the property has 15-year and how much is 5 year, and you blend all of the math together, and that tells you, so once it goes down to 0, I will still be crazy busy, and people should still do cost seg.
Okay. I like it, and it's all legal. It's all totally there for you. Where I've seen this, and I've worked with a number of real estate investors with single-family homes, condos, things like that. You can do it for condos too, right?
Now, for condos is a little different of an animal. We charge $100 more to do a condo. And I'll explain why. It's very simple. Is that the condo owners a lot of times don't realize this, but either it's a commercial or residential condo. All the condo owners own the land and they own the land improvements. So when we go out to a condo, even though you might have one condo out of 100, we have to look at all the land and divide out what your 1% you own. So therefore, it takes us a little bit more time because we're looking at all the land improvements. If it's a residential condo, we're looking at the swimming pool, the clubhouse, the parking lot. And then we carve out, if you own one condo and you own 1.5% of that whole condo complex, then we have to carve out the 1.5%. So that's why condos are a little bit more, but it's still valuable. It still works.
It seems like the land is less of a percentage, so your potential write-off could be higher. Do I have that right?
No, it's going to be a good report, but it's going to be pretty much in the same. The math will work out pretty much the same as if you owned a single-family home, because usually if there's 100 condo development, you only own 1%. That's still going to be a big number. 1% of a huge 100 unit condo there's going to be a lot of land improvements. It's going to be worth a lot.
All right. Well, I like it. Because it's really proof that something like 98% of the people out there who file tax returns are paying too much money, right?
Right. And I want them. My first defense when I talk to my clients is I say, look, here's what I'd like you to do. I'd like to take your tax savings and either improve your properties or buy more property. That's what I want you to do. Now, whatever they do with the money, I don't care. But I think if you're really in this game to be a savvy investor, take your tax savings and grow your kingdom.
All right.
That's what I do.
Okay. Just tell us again how we connect with you.
Well, it's U.S. Tax Advisors Group Incorporated, but it's simple. It's USTAGI.com.
All right. Hey, got a question for Joseph, myself. The email address is kl@kerrylutz.com. And hey, while you're at it, you'll find the link to Joseph's site on our site, financialsurvivalnetwork.com. Make sure you sign up for your free newsletter so you find out about opportunities like this. I mean, look, you got 3 years to file an amended tax return. If you miss this, it could be a huge savings on your taxes.
Well, here's one. Let me stop you right there.
Sure.
All the work that we do, the word that starts with an A that you mentioned is not in our vocabulary. Cost segregation is not an amendment. Cost segregation is guaranteed by the IRS and by IRS regulations. Even if you do a look-back study, we don't amend the return. The IRS grants you special dispensation. If you go do a look-back study, you have to file a form called the 3115 and change your accounting method. But I want to make sure it's not amending. It's guaranteed approval by the IRS. They must take a 3115 for cost segregation. They don't have to take it for any other changes, but for cost segregation, it's grandfathered in.
Right.
They must approve cost segregation. So if anybody asks me about amending the return, I tell them, don't do it if you have to amend the return. That's my advice, because amending returns is a red flag.
All right. We love it. So it's not an amended return per se. I mean, effectively it is, but it's not an amended return that's going to draw added scrutiny.
Right.
It has to be accepted by law, which is a great thing. And look, you might be depreciating your property over 27 years, and this could be a huge tax savings to you if you do it promptly. Do they only have 3 years to go back, Joseph, or can they?
No, it's a mathematical equation. There's no bright line in the sand, but I will tell everybody with my experience about 15 years. Now, I don't care how old the property is. George Washington could have slept in the property. I'm talking about when somebody bought the property. We can go back 15 years, and I'll do the estimate for no charge. And if it doesn't work, I'll be the first to tell them, it just doesn't work for your property. What I like to see is 10 times the fee. So if I'm charging you $625, I want you to save $6,250 in income taxes. If you're not going to save that amount of money, I'll be the first to say I wouldn't do it if I were you. Now, if you want to do it, that's okay. But my recommendation is I think it makes sense for 10 times my fee.
Okay. I think anytime you can get 10x on an investment, and immediately, without any risk whatsoever, you should probably do it. Got a question for Joseph, myself, email address kl@kerrylutz.com. Make sure you go sign up for your free newsletter. You'll get all that info. Joseph's contact info will be in it. And Joseph, really fascinating stuff. Thanks for coming on. We'll talk to you again soon.
All right, Kerry, thank you. Good job.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.